Welcome to Breaking News to Trading Moves. Today we're zoning in on a really specific headline, one that's made some waves in the consumer staples sector, especially for one particular household name.
We are. And we're talking about Kraft Heinz. The ticker is KHC.
Right. And the big story here, the starting point for all of this, is that the stock has hit a near 6-year low.
It's a situation that really combines a few different threads. You've got corporate restructuring, you have major shareholder moves, and just a real change in market sentiment.
And the stock took a serious hit on this news. I mean, it fell about 7% intraday. And the trigger for that, it wasn't the usual suspect, was it? Not a bad earnings report or some kind of product recall?
No, not at all. This all came from a filing.
A filing.
Yeah, specifically an SEC prospectus filing that came from Berkshire Hathaway, ticker BRK.B.
Okay, so Warren Buffett's company.
The very same. And in that filing, they disclosed that they may sell their stake in Kraft Heinz.
And when you say stake, we're not talking about a small position here.
Oh no, it's substantial. The filing covers up to 325.4 million shares.
Wow. And that's basically their whole position, isn't it?
It is. It represents essentially their full 27.5% stake in the company.
Let's just put a number on that. Based on the close before the news, that's something like, what, $7.7 billion?
Around that, yes.
Yeah.
And that number, that 7.7 billion, that's exactly why the market reacted so sharply.
Yeah.
It definitely spooked investors.
So let's break that down because they haven't actually sold the shares yet, have they? The filing just says they may sell. So why such an immediate drop?
Correct. They've only disclosed that they could sell, from time to time. But this introduces something we call overhang risk.
Overhang risk. Okay, so define that for us in this context.
It's all about perceived supply. Even if Berkshire doesn't sell a single share tomorrow, just the act of registering them for sale puts that availability on the table.
So the market just knows there's this huge block of stock.
A block at over 300 million shares. That could hit the market at any moment. And that pressures the stock price.
Because buyers get hesitant.
Exactly. Why would you step in and buy today if this massive seller is just looming in the background? The pressure stays on until the market gets some clarity on, the timing and the pace of any sales.
So it kind of puts a ceiling on the stock. But there's a history here too, right? I mean, Berkshire isn't just any old shareholder.
That's the whole other side of it. It's
Yeah.
about the sentiment. Berkshire Hathaway actually helped create Kraft Heinz back in 2015. They were there from the beginning.
And they've taken some big write-downs on it over the years, if I remember correctly.
They have. So if they're looking to get out now, the market sees that as a pretty powerful signal.
It looks like a capitulation.
That's the word for it. A very high-profile capitulation. If the entity that helped build the company is now registering shares to sell, investors read that as a clear signal. It changes the whole story around the investment.
Like a vote of no confidence.
That's certainly how the headline is being read.
Okay, but this gets even more complicated because Kraft Heinz isn't just, standing still while this happens. They have their own big plans in motion.
They do, and that's the big complication here. Kraft Heinz is right in the middle of a major strategic reset. They're planning to split the company into two separate businesses.
And what's the plan for that split? How's it breaking down?
The idea is to separate the North American grocery business from the global sauces and spreads business. And they're targeting the second half of 2026 to get it done.
So you have a company trying to pull off this massive structural change, and at the exact same time, their largest shareholder is signaling for the exit.
It just creates this conflict. This potential Berkshire exit adds a huge layer of uncertainty right in the middle of a transition. When you're planning a split like this, you want stability. You want a stable shareholder base. This is the opposite of that.
It definitely muddies the waters. So we have the setup. KHC is down, Berkshire signaling a sale, there's a split coming. But, money in the market doesn't just disappear, it moves.
It rotates. It always does.
So let's talk about the winners. If investors are selling KHC, but they want to stay in consumer staples, where does that money go?
They start looking for what you call cleaner narratives. If you're getting out of a stock with all this overhang and restructuring uncertainty, you're probably going to put that capital into peers that just have, steadier execution or a better story around innovation.
Okay, so who are the direct beneficiaries in packaged food and snacks?
There are three names that typically come up in this kind of rotation. First is Mondelez International, that's MDLZ.
Okay.
Then you have General Mills, GIS. And the third is the Hershey Company, HSY.
And why those three specifically? What's the common thread?
To put it simply, they have less drama.
Hmm.
Mondelez and Hershey have these really strong snacking businesses, which tend to get a better valuation than General Grocery. And General Mills is just seen as a really steady executor.
So if you're a portfolio manager, you take the money out of the one with the overhang.
And you put it right into the one with the more predictable path. You swap uncertainty for stability.
That makes perfect sense. Now, there's another group of winners here, and it's not the food makers, but the companies selling the food.
The retailers, right.
Yeah, there's a Reuters note here that mentions Kraft Heinz has been facing more competition and some pushback from consumers.
And that's a really key part of the story. Consumers are getting tired of price increases. So when branded food prices get too high, what does the average shopper do?
They trade down, they buy the store brand.
They buy the private label.
Yeah.
Exactly. So if that trend holds, if shoppers keep moving away from big brand names like Kraft or Heinz, then the retailers with really strong private label programs are the ones who benefit.
And who are we talking about there? Which tickers are set up to win?
You're looking at the giants. Walmart, WMT Teal, Costco Wholesale, COST, and Kroger, KR.
Right, Walmart and Costco in particular are just famous for their private label brands.
They are. And in this kind of environment, where a big branded supplier like Kraft Heinz is struggling, these retailers, they gain leverage. They capture that customer who's walking away from the branded product.
Okay, so we've got rotation into other food stocks and the shift to value retailers. But there's a third group of winners, and this one is a bit more behind the scenes.
The advisory ecosystem.
The people who make the deal happen.
Exactly. It's all about transactional revenue.
Yeah.
You mentioned the complexity. A corporate split combined with a massive secondary sale. Well, all that complexity generates fees.
Even if Berkshire just sells gradually over time.
Even then, you need underwriting for the split. You have trading revenues from the share sales, advisory work. I mean, just separating a company this big into two pieces requires a ton of banking and legal horsepower.
So the banks get paid no matter which way the stock goes.
For the most part, yes. The activity itself is what drives the revenue for them.
And which firms are likely to see a piece of that action?
It's the usual heavyweights you'd expect in deal advisory. Goldman Sachs, GS Morgan Stanley, MSS, and JP Morgan Chase, JPM.
So while the company itself is under pressure, the financial services side actually sees an opportunity.
That's it.
All right, let's flip to the other side of this. We know the direct loser here is Kraft Heinz.
Right. To be clear, the immediate pressure is on the Kraft Heinz company, KHC. And of course, that affects the value of the stake that Berkshire Hathaway holds, BRK.B.
It's that headline-driven pressure, but does the pain stop with just Kraft Heinz?
Not always. There's a concept called re-rate risk that can come into play.
Okay, explain that one.
Well, when a major respected investor like Berkshire signals they're getting out of a legacy food company, it makes other investors take a hard look at the whole sector.
They start asking if other companies might have the same issue.
That's it, exactly. They check the whole aisle. If the smart money's leaving Kraft Heinz, they'll look at other brands that are also seen as, maybe slower growth or less innovative, and they start to wonder if they should be selling those too.
It's sort of a contagion effect.
It is. It casts a shadow over companies with a similar profile.
So which companies fall into that bucket?
The names that often get brought up here are Campbell Soup Company, CKB, also Kellanova, which is ticker K, and the J.M. Smucker Company, SJM.
All classic American pantry staples.
They are, and they share some of those same characteristics as Kraft Heinz. They're all navigating this changing consumer landscape. So if sentiment turns south on the category leader, these other stocks can definitely feel some sympathy pressure.
So it's assessment by association.
It's a reassessment of what valuation the market is willing to pay for that type of company.
And there's another layer to this idea of center of store pressure.
Right. If you think about a grocery store layout, the center of the store is where all the processed, shelf-stable stuff is. The perimeter is where you find fresh produce, meat, dairy.
And the story for a while has been that the center of the store is facing headwinds.
Correct. Consumers are either moving toward fresh foods on the perimeter or, as we said, trading down to private label. So if the market story becomes the center of the store is in trouble, then adjacent categories get sold off too.
Like processed proteins?
Yes, exactly. Processed protein and other shelf-stable brands can get caught in that sympathy selling.
And who are we looking at there?
The two big ones are Hormel Foods, HRL, and Tyson Foods, TSN.
So even though they're more focused on protein than ketchup, That broad packaged goods sentiment can drag them down, too.
It can. It's about the bigger category narrative. If the market decides that branded packaged goods are facing a structural problem, it tends to sell the whole basket.
Okay, so we've covered the drop, the context, the winners, the losers. For an investor or a trader who's watching this unfold, what are the key things to watch next?
I'd say there are three main areas to keep an eye on. First are the execution details of the sale itself.
You mean how Berkshire actually gets rid of the stock?
Exactly. Is it going to be a slow, gradual sell down on the open market? Or will they try to arrange a few big block trades to institutions? The method they choose really matters for the day-to-day stock movement.
A block trade could clear the overhang faster.
It could, but a slow drip could mean pressure for months. That's the detail we're waiting on.
And the second thing to watch.
That goes back to the internal strategy, the split specifics. We need more details on that planned two-way split.
What kind of details?
The timeline is huge. Is that second half of 2026 target still on the table? We need to know about brand allocation, which brands go to which new company, and most important, what are the margin targets? Investors need to model what each new company is going to look like.
Because that's what determines if the sum of the parts is worth more than the whole.
This is the whole point. The logic of the split has to be convincing enough to maybe counteract some of this selling pressure.
And the third factor to watch.
Management strategy. Kraft Heinz has an incoming CEO.
A critical variable. New leadership can mean a new direction.
And the market is going to be watching that new leadership's credibility very, very closely. The big question is whether the strategy shifts. For so long, the story here has been about cost cutting.
Trying to save your way to growth.
Right, but you can only cut so far. What the market wants to see is a shift from just cutting costs to driving actual growth and innovation. Can they make these brands exciting again?
That's the ultimate challenge. It's one thing to manage a decline, it's another to reverse it.
And trying to do that while your biggest, most famous shareholder is heading for the door, well, that makes the degree of difficulty a lot higher.
It really raises the stakes. You've got this external pressure from the stock sale hitting up against the internal pressure of a major restructuring.
And the outcome of that collision is really what's going to drive the stock over the next year or two.
It really leaves you with a final thought to mull over, doesn't it? In a situation like this, what's the bigger driver of the stock price? Is it the company's own actions, the split, and the strategy? Or is it the flow of funds, the actions of a major shareholder?
In the long run, it's almost always the business fundamentals. But in the short run, flows can absolutely dominate the price action.
And that's the balance investors have to weigh right now with KHC.
It is.
We're going to leave it there. A lot of moving parts in the consumer staples aisle.
Indeed.
Before we sign off, just the usual reminder for everyone. This is not financial advice. It's not a buy or sell recommendation.
This is purely the opinion of the author. Always do your own research.
Thanks for tuning in to Breaking News to Trading Moves. We'll catch you on the next one.